Hello, everyone. It is Sunday, June 27th, and this is episode 19 of Odds Are, your S&P 500 weekly market forecast. All right, so I was able to recover the relative view from last week, which we were not able to show you because the software program that I was using was undergoing some updates. But here we go. Let's pull this up here. All right, you can see that the market just completely blew past the upper settlement limit, the upper breach point, and for the first time in quite a while, actually did settle outside of the expected settlement range. Now, nothing to be alarmed about there, right? Because most of the time, our the odds of that happening, of staying within the expected settlement range, are around 79%, which means that 21% of the time, it does close outside of the expected settlement range. So no shocker there, but it definitely did close higher, above the breach point, above the settlement limit, and nowhere near that parabolic SAR. So see here that we have pushed up the range of the Bollinger Band. You can see that top blue line from the blue shaded area has been kind of like stretched upward. So it's like encountering that resistance, but kind of pulling it up along for the ride. So we'll see what happens here in the week to come. Let's pull the moving averages now and back to green. So we keep toggling back and forth between bullish and neutral, bullish and neutral. Every time we have kind of a down week, it'll go down to neutral in the short term. And then the very next week, we're back up to bullish. Which is still, everything's still holding steady on the medium and long term though. Everything's still bullish on medium and long term. So we have not seen any flips on those yet. We'll see if this coming week we go back down to neutral. All right, let's pull up the breach points. All right, so your lower breach point for this week is going to be 41.75, and your upper breach point is 43.25. So nice big wide range there, still with an 81.28% chance that we will breach one of those 2 points. So let's add in the expected settlement range now, and you have the expected settlement range is now between 41.57 and 43.50. Back to its normal relationship with the breach points, where the expected settlement range is outside of the breach points. And again, we're looking at a 78.98% chance it will close within that expected settlement range. Even though that is mathematically the odds of it closing within that expected settlement range, I will say that the fact that we closed outside of the expected settlement range last week makes it even more likely that we will close within the expected settlement range this week. But still, the numbers are just looking at the population, the numbers basically over the last 21 years as a whole, but something to keep in mind there. All right, and now we're going to add in the parabolic SAR, which is now at 41.09, back outside of the expected settlement range. So the upward movement was so strong that we now brought the expected settlement range for the week higher and left that parabolic SAR down in the dust a bit. So we're still down at 41.09. So can we close below it? Yes, but that would also mean that we would have to close outside of the expected settlement range again, which is not very likely. So my call, we are not going to be closing below that 41.09 unless something really drastic happens. All right, let's wrap all this up into the relative view. And again, you see a nice big wide open space there. Again, these ranges, these breach points and settlement limits are going to expand and contract based on the amount of movement in the market, right? So highly volatile markets will require a little bit more breathing room. And as markets tend to kind of coil up or, consolidate, then you're going to get that tightening of these ranges. Right now, they're pretty wide open because we've had quite a few moves in the last 2 weeks and extremes on those ranges that basically requires that extra space. All right, and now we're going to go into, didn't see that one coming. So another all-time high. Another all-time high last week, which I didn't see coming because at this point, it's kind of verging on, on the verge of ridiculousness, honestly. There's plenty of people out there that are going to disagree, and there's plenty of people out there that are saying, "Oh, you're crying wolf." I'm going to show you guys a chart here, and I am not a chartist. I don't trade off of charts, but I do think that they provide interesting context for the market that you're in and the systems that you may be trading. So let's take a look at this. So hope you're not afraid of heights. This is the S&P 500 monthly chart from 1997 just until this past Friday. And take a look at where we're at. Now, that blue line at the very, very top above where it says S&P 500, that's where we're at. And you can see going back to 2000s, the dot-com bubble, you can go back to 2008, you see that great recession, and then you just see what we've done since then. But what's really interesting is the Bollinger Bands, which we normally see that blue shaded area, right? There's a solid blue line at the top, a red midline, and then a solid blue line representing the bottom of that band. Look at the gap. Look at the distance between the top line and the bottom line. Like we were just talking about how when the market moved up, it like stretched that Bollinger Band up to the top side. I mean, just look at this chart. Look at what it's doing to that Bollinger Band. Look at how high it's stretched. And as one thing we know about, bands, right? So like think about like a rubber band. Eventually it's going to snap back. And that distance, that gap between the lower end of the Bollinger Band and the high end of the Bollinger Band, I mean, as far as recent recorded history, right? I mean, we can always go back even further, but this is going back to 1997, which I think is plenty to capture the current market dynamics and then some. In that recorded history, we've never had that much of a gap, and it's only getting worse. So I do see a snap back, and I do think that we're going to have to come back, if nothing else, at least to that red midline, which right now it's around 34.51. That's huge. That's like, almost 1,000 points for it to get back to the midline. Just take it for what it's worth, and hopefully you guys are prepared for what may come. All right, and then we'll wrap up as always with the quote of the week. There will always be bull markets, followed by bear markets, followed by bull markets. And that was Mr. John Templeton, who was a very well-known investor, hedge fund manager, philanthropist. But just looking at the cyclical nature of this, we know that eventually this has to turn. And just looking at the magnitude with which it's gone up, with like seemingly no end in sight, like I've used this term before about whether it's sustainable or not. I think that showing that stretch between the Bollinger Band really kind of highlights that point where it's stretched to its limit. And what happens when things are stretched to their limit? They're either going to bounce back or they're going to break. Hopefully it doesn't break you. Hopefully we're all able to bounce back. And hopefully this week brings great things for all of you. But until then, I will see you guys next week. Take care, and we'll see what happens.